Personal lines exam. Welcome to the quiz. In personal auto insurance, what does the term split limits refer to? Is it A, a policy that covers only one vehicle? Or B, different coverage limits for bodily injury per person, per accident, and for property damage? C, a policy that splits coverage between collision and comprehensive? Or D, a discount for insuring multiple vehicles? The answer is B. Split limits, also called dual limits or 15/30/10 style, in a personal auto policy means the liability coverage has separate dollar amounts for different types of losses, one limit for bodily injury to one person, a higher limit for total bodily injury per accident, no matter how many people, and a separate limit for property damage per accident. For example, 25/50/25 means $25,000 max per injured person, $50,000 total per accident for bodily injury, and $25,000 for property damage. This structure is the most common way auto liability is written in the United States because it provides clearer protection levels and matches most state minimum requirements. It helps ensure that in a serious accident with multiple injuries, the policy can pay up to the per-accident limit without being capped too low by a single-person limit. Option A is wrong because split limits have nothing to do with the number of vehicles covered. Multi-vehicle policies use the same limits across all insured cars. Option C is incorrect because collision and comprehensive are separate physical damage coverages, not split liability. Option D is wrong because multi-car discounts reduce premium but do not define split limits. Next question. What is the primary purpose of the HO3 homeowners insurance policy form? Is it A, it is a basic form for tenants, renters, or B, it provides open perils coverage on the dwelling and named perils on personal property? C, it is a comprehensive form for condominium owners? Or D, it covers only named perils on the dwelling? The answer is B. The HO3 special form is the most common homeowners policy form for owner-occupied single-family homes. Its primary purpose is to provide the broadest standard protection, open perils, any cause of loss except those specifically excluded, on the dwelling, coverage A, and other structures, coverage B, while personal property, coverage C, is covered on a named perils basis, only the listed causes like fire, theft, windstorm, etc. This combination gives strong coverage for the home structure against sudden/unexpected losses, while personal belongings have more limited, but still broad named perils protection. It is the industry standard because it balances comprehensive dwelling coverage with reasonable cost. Option A is wrong because HO4 is the renters/tenants form. Option C is incorrect because HO6 is for condo owners. Option D is wrong because HO3 uses open perils on the dwelling, not just named perils. HO2 uses named perils on everything. Next question. In personal lines, what does UM/UIM stand for? Is it A, underwritten motor/underinsured motorist? Or B, uninsured motorist/underinsured motorist? C, unified market/underwriting management? Or D, unlimited medical/unlimited liability? The answer is B. UM/UIM stands for uninsured motorist and underinsured motorist coverage. UM pays for your bodily injuries and sometimes property damage, depending on state, when you are hit by a driver with no insurance or who flees the scene, hit and run. UIM kicks in when the at-fault driver has insurance, but the limits are too low to cover your damages, e.g., their policy is $25.50, but your medical bills are $100,000. This coverage protects you when the other driver cannot or will not pay fully, and it is especially important in states with many uninsured drivers. Many states require insurers to offer UM/UIM, and some make it mandatory. Option A is wrong because underwritten motor is not a standard term. Option C is incorrect because it does not relate to coverage types. Option D is wrong because UM/UIM is not unlimited and does not cover medical or liability in that way. Next question. What is the primary factor used to determine a personal auto insurance premium? Is it A, the color of the vehicle? Or B, the driver's credit-based insurance score, driving record, vehicle type, and location? C, the driver's annual income? Or D, the policyholder's marital status only? The answer is B. Personal auto premiums are primarily determined by a combination of risk factors. The driver's credit-based insurance score, in most states, driving record, accidents, tickets, DUIs, vehicle type/make/model/year, repair costs, safety features, theft rates, garaging location, crime rates, traffic density, weather risks, and mileage/usage. These factors statistically predict claim likelihood and severity. Insurers use complex rating models where poor credit, bad driving history, high-performance cars, or high-crime areas significantly increase premiums, while clean records, good credit, safe vehicles, and low-risk areas lower them. This is why two drivers with the same car can pay very different rates. Option A is wrong because vehicle color has no material impact on premiums, though some myths exist about red cars. Option C is incorrect because annual income is not directly used. Credit score is a proxy in allowed states. Option D is wrong because marital status is a minor factor in some states, but not primary. Next question. Which homeowner's policy coverage pays for expenses if you cannot live in your home due to a covered loss? Is it A, coverage A, dwelling? Or B, coverage C, personal property? C, coverage D, loss of use? Or D, coverage E, personal liability? The answer is C. Coverage D, loss of use, also called additional living expense or ALE, pays for reasonable extra costs when a covered loss makes your home uninhabitable, e.g., fire, windstorm. This includes hotel stays, restaurant meals, laundry, pet boarding, or rental of a similar home until repairs are complete or you permanently relocate. It is time-limited, usually 12 to 24 months or until exhausted, and percentage-based, often 20 to 30% of coverage A limit. This coverage ensures you are not financially devastated while displaced. Option A, dwelling, repairs the structure. Option B, personal property, covers belongings. Option E, liability, protects against lawsuits. Next question. What does a floater or endorsement typically provide in a homeowner's policy? Is it A, increased liability limits? Or B, scheduled coverage for specific high-value items like jewelry? C, coverage for flood damage? Or D, a discount for new roofs? The answer is B. A floater, or scheduled personal property endorsement, provides specific, broader coverage for high-value items like jewelry, fine art, collectibles, cameras, silverware, or antiques that exceed standard personal property sublimits, often $1,500 to $2,500 for theft. The item is scheduled with an agreed value, covered on an all-risk/open perils basis, few exclusions, often with no deductible and worldwide protection. This is important because standard HO3 personal property limits are inadequate for expensive items. Option A is a liability increase endorsement. Option C requires separate flood policy. Option D is a discount, not floater. That's it for today. Don't forget to like and subscribe. Tell us how many you scored out of 6 in the comments, and let me know what topic I should post next. Bye.